Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck, and this will be my first blog for calendar year 2010, and hope everyone had a great holiday season, and I'm looking forward to a happy and most importantly a prosperous new year. And I thought one way to start the new year off would be kind of take a look at where the markets ended up and maybe what we could expect to see with the markets going forward. And the best way to do that is to look at our Fundamental Research Analyzer tool and look at the S&P 500 from the perspective of earnings. I'm going to start with a 20-year example. I want you to notice that over the last 20 years, the earnings growth rate of the S&P 500 has averaged 6.1%. But I also want you to notice that, it's been relatively erratic. We had some real good earnings growth, starting from the period 1991 all the way through the period 2000, which ultimately led to this irrational exuberant period where the S&P 500 became massively overvalued. Valuation is so important to investing success, ladies and gentlemen, and what that resulted in was a period of, which again Alan Greenspan called the irrational exuberant period, that led to a tremendous collapse in stock prices in the horrific bear market that was totally justified based on overvaluation. I want to make point number one there. Then after the markets corrected, and of course the recession of 2001 came, which we can see right here where earnings of the S&P 500 fell, then we had this 5 or 6 year period where earnings growth was real strong, and of course stock price followed that until we hit the horrific recession of 2008. But the point I want to make here, this wasn't really as much an overvaluation issue as it was an earnings issue. You can see that what happened here was stock prices actually followed earnings, and so this drop in the S&P 500 was actually justified in my view based on earnings. And of course the recent rise in price in 2009, which was a really good year for most investors, where the S&P was up over 25%, correlated very closely to its increase in earnings of 20-some%. But the bottom line is it did get slightly overvalued. The normal PE ratio, which is marked by this blue line for the S&P 500 for this past 20-year period, has been 17.5. But I want you to notice that a lot of that has to do with this period where valuation was so high during what I call the irrational exuberant period. If you look at the last 80 years, the normal number for the S&P is about 15, which is actually, ironically, what the green line just happens to work out to here with the white triangles, represents 15.9. So that's slightly higher than the normal valuation of the S&P. So at 19 times earnings, whether you're using 17.5 as the 20-year average or 15 as the 80-year average, it's arguable that the S&P is slightly overvalued, or ended 2009 slightly overvalued at just over 1,100. On the other hand, if you look by year-end earnings justified level based on the estimate of 73.50 by the leading analysts, as reporting to First Call. By the way, I also read an article where Goldman Sachs is forecasting $75. So assuming this is a reasonable number, then the S&P ought to be somewhere by year-end 2010 at around, let's say, 1,200-ish. So there is some room for the S&P to rally based on historical normal earnings growth. So, when we look at the S&P from this perspective, you could argue that it's modestly overvalued currently, but slightly undervalued by year-end. The point is there's not a lot of risk in the market now, and everything's going to be determined by how well earnings grow, not only in 2010, but of course in the years following that. So just to give you a little perspective of kind of where we are in the market, and I want to conclude this by also saying, as I'll be showing in some subsequent blogs, that it's really about individual companies anyway. This is a general picture of the market. I'm going to be showing in blogs later on in the week some companies that have what I consider to be extraordinary fundamentals. This is what we call the average. I'm going to look at above average companies that have some good growth potential, and tune in for that. I hope you'll find it interesting. This is Chuck Carnevale. It's good to be back, and I'll talk to you again tomorrow. Thanks for listening.